From time to time, we talk to people we think you might find interesting, informative, perhaps even inspiring. Today, we're going to talk to Daryl Roxburgh, who's the global head of BITA Risk. Daryl, here's your coffee.
Andrew, good morning. How are you?
I'm good. Daryl, we work in a sector that takes very specific meaning into the words that it uses. Some might call it jargon.
Yes.
One of those key words that the industry has been talking about now for some time is something called suitability. Suitable to what? What does suitability mean?
I think there's probably two ways of thinking about this. There's what the regulator would look at it, how the regulator would look at it, and there's how the private client and the wealth manager would look at it.
Okay.
Funnily enough, the two are actually very strongly linked. In both cases, what's trying to be achieved is to make sure that the investments that are made on behalf of a client are suitable for them. And what does that mean? It means, are they suitable for achieving the goal that the client has set? Whether that's a goal to generate income, to save for retirement, or for some other purpose, to preserve their wealth, for example. Are the investments suitable given the client's overall financial position? In other words, should they actually be taking risk with this money? Or given the other liabilities they've got in their lives, should they be looking to minimize the risk with this asset so that it can support them if something else goes wrong in their life? And then thirdly, is the risk suitable for the client? Have they actually got the right sort of personality to take risk in terms of investment? Are they going to be scared when the market takes a dive? Are they going to be upset if they're in a conservative portfolio and the market rolls ahead? So bring those three things together. Is a portfolio going to be suitable for the goal? Is it suitable for the client to be taking risk with this assets? And is the client actually able as an individual and personality to take this level of risk with their investment?
But Daryl, aren't we making a bit of a mountain out of a molehill? Surely it's easy. When an investor starts off in life, they can take a lot of risk because if things go wrong, there's a lot of time to catch back up. But as you get towards the end of your investing horizon, generally when you get older, there's less time for things to go wrong. So surely we're making this much more complex than what it needs to be.
You could generalize like that, Andrew, and I think for a lot of fairly simplistic investment, that may be a way of approaching things. But where an individual has got other assets, where they've got variability in terms of their liabilities in their life, where it's a fairly significant part of their assets, then you need to be looking at this in much more depth. The FCA gave a very good example some years ago. A man wanted to invest money to pay for his daughter's university education. He only had £15,000 to invest. Now, he could not afford to lose any of that money. In fact, it was more important that the value of that money was preserved to help meet those educational needs than it was grown over the period.
Okay.
So there you've got a very simple retail example. And even there, it was important to understand that there was no other pot to turn to meet this need and objective going forward.
So clearly for the private investor, it's clearly important that they have an asset allocation that meets their needs. But what does that mean for the private wealth manager, for the investment manager, for those folk who actually run the money? What should their response be? What do they need to do to ensure that their clients are investing in assets or asset allocations that are appropriate?
I think first and foremost, the wealth manager needs to make sure that they and their client have got a common understanding. Too often it's been, oh, you're medium risk. Well, your idea of medium risk and my idea of medium risk may be completely different. Secondly, they need to make sure that that asset allocation or portfolio that they're providing to the client, that the wealth manager understands its characteristics. Does that tie in with the risk characteristics that are suitable for this client? So from a manager's perspective, they need to have a consistent approach to the way that they assess the risk a client is prepared to take, if we say the suitability profile, and they need to have a way of consistently assessing the portfolios that they're creating to make sure that they correspond with that, the risk needs of that.
So I think it's fair to say, well, perhaps let me ask the question, is it fair to say that historically our industry has often seen suitability as a tick box exercise?
I think a very brief history lesson. In 1986, just ahead of Big Bang, the concept of client agreement letters was introduced, where you actually had a contract with your client that specified how you were going to manage your portfolio. In 86, you'd look at it in terms of high, medium and low risk, income balanced and growth. And that has persisted through the industry ever since. It's not very clear what high, medium and low actually mean in practice.
Sure.
And so I think from that side, the manager needs to establish much more detail about this with the client in terms of what the expectations are. Initially, when the regulator started from sort of 2005 onwards with increasing the focus on suitability, it was seen very much as a tick box. We've done this, we've ticked it, we've done it, we go on. Now more and more firms are actually looking at this and saying, well, wait a minute, a fundamental part of investment is risk management, and a fundamental part of a client's suitability profile and what the service we're delivering to that client is risk management. And I think you'll find today that private investors are looking much more at the risk management functions that a firm has and processes to ensure that their needs are going to be met through time, not just at the initial outset.
Well, Daryl, what's looking through my head hearing you speak there is that it sounds like suitability and risk are essentially synonyms to each other. Is that the case?
The degree of risk, yes, that can be suitable for somebody. There are many other facets to suitability in the construct of the portfolio, but probably one of the most fundamental would be the risk. But then one needs to also think about other aspects of risk. What is the liquidity on the portfolio? What is the time horizon that the client's looking at? What is the client's income need from this portfolio? What are is the tax position of the client? And all of these actually focus in on how you construct that portfolio for the client. So risk is one aspect of that overall portfolio construction.
It would seem that the FCA, the regulator here in the UK, has really put suitability at the top of its agenda. There are clearly other issues, but that's certainly one of those items that it's put at the top of its agenda. What do you think that the FCA is actually trying to achieve, and what does that then mean for financial service providers?
I think at the end of the day, they're trying to achieve the client getting what they expect. And you can think of the whole of suitability as helping a client understand what they might expect, setting expectations with that client, and then managing that client's expectations and managing their investments to meet those expectations. To use the old advertising phrase, it does what it says on the tin. And I think this is really what a client should be able to expect when they go into a firm and are assessed as to what will be suitable for meeting their needs, and then have the parameters set out within which that can be done. It's also very fair to say that all investments are subject to the whims of the market, and to predict what the market is going to do over a short time horizon is extremely difficult.
So it sounds to me that suitability is raising the bar, causing everyone to get serious, whether it's the private investor, whether it's the financial service provider, or whether it's the regulator, to actually take suitability far more seriously. So with that in mind, what are the sort of top 3, top 5 takeout items that any private wealth manager, any asset manager should have on their agenda as they look at how they will deal with suitability today and into the future?
I think first and foremost, it's got to be about being able to educate the client and agree with the client on the basis of a common understanding how their portfolio is going to be managed and how they might expect it to perform from a risk perspective. The manager must understand the client's objectives and their time horizon and be able to say with confidence that the portfolio that they're providing is suitable for meeting those objectives. In order to do this, they need to be able to do it on a consistent basis. So some form of framework is critical. Not least because a firm now should be looking at its management information across the client base, understanding how clients are being profiled, how their portfolios are being run to meet those profiles, how that's being reviewed on an ongoing basis. So having some form of structured framework to perform this is critical to efficiency. Because one of the problems early on is that people ticked boxes for the sake of ticking boxes because it was time saving. And now as people look at this far more as a fundamental foundation of their relationship with the client, it still needs to be efficient and quick and easy, but at the same time it needs to be done in more depth.
So Daryl, this sounds like this is something that stretches all the way from client onboarding all the way through to the actual performance of the asset class that they're in. Would that be correct?
Not necessarily to the asset class, but it's all the way from the onboarding of the client and their objectives through the proposition to the client, to the portfolio that's proposed, to the ongoing management of that portfolio, to the investment strategy of the organisation. So really what a strong, good suitability process would do is link the client's needs to your investment strategy. And that is a really important join so that you're making sure that you deliver what you expect to deliver and what the client would expect from you.
Daryl, thanks for meeting with me today.
Good
Much
to see you
appreciated.
again. Thanks.
Bye.